Good evening, traders. Welcome to another Trade Your Way video. This one we are going to be talking about Elliott Wave and the Elliott Wave Theory. I was asked to make a video on it, and so I thought, why not? Because we've just had a decent Wave 1 to 3 set up on the pound dollar, which we were using Elliott Wave to track and monitor and stalk the price to the downside. So I want to talk you through it. So what is Elliott Wave? So Elliott Wave is a way of monitoring the price action in terms of the way it moves. So everything tends to move in like a leg in different stages. So a leg down here, and then we have the pullback, then we have a continuation, then a pullback, then we'd look for another continuation, etc., etc. And that's pretty much how stock markets and every market moves, right? So they move in waves. So this is what the Elliott Wave theory was brought in, which goes back to the 1930s. So it's going back some years. So what we talk about here, what we want to identify is whenever something, so whenever a stock market decides that it wants to put in a move, or whenever a forex pair decides it wants to make a decent move, we will, we take that into consideration. We don't think anything of it because that's the first wave. It's when it pulls back to a wave 2, which is often to a 61.8 or a 76.4 retracement, and then does this. That's when we take note that we could be in the makings of an Elliott Wave move. So with an Elliott Wave theory, Wave 3 is always the biggest move. And so what happens generally is we will have a Wave 2, a correction, a Wave 2, which is, it corrects the Wave 1, but it never extends beyond the starting point of Wave 1. So typically it will move and retrace, like I say, 61.8% or 76.4%. The bigger the retracement, the bigger the move down for Wave 3 potentially. So if I just show you this very quickly, this was the first move down, and we were looking for the retracement up, and you can clearly see if I do away with those fib extension levels, that this, and a 50% and a 30%, and let's not extend it. Let's just show you the two levels. 61.8, 76.4. So we're looking for price to get up there, and that is a completion of your wave 2. So you have your first impulsive wave down, then we have the correction. Pretty much the Elliott Wave theory was used, or is used, for the break and re-entry or break and retest kind of theory. It's that kind of concept where we are acknowledging price action when it moves. So when we have a breakout, we wait for the pullback before we get in, so a break and a retest. Same principles with Elliott Wave. So we have the Wave 1 move, and then we have the impulsive pullback Wave 2. Now if we can get, as I say, if we can get like a Wave 2 pullback to 61.8, or ideally the 76.4, which is what it did here, and that's why it made me pay attention to this price action, then we're interested. We're interested in taking the shorts and being short and being bearish until the completion of Wave 3. Now Wave 3 is usually the largest and most powerful wave in a trend, because often this is when people start to, traders start to come in, they start to see that this is potential here. It's failed to go to the upside and it's starting to go down, and so we have this big impulsive move again. And usually it doesn't faff around like this as much, but this is the pound dollar. It's been quite a slow and steady week last week. We would usually just have a quite a straightforward decent move down. This took about a week, but it still got there. And what happens is that traders will start to see this move down and think, okay, this is possibly bearish, and so the rest of the crowd will often join the new bearish trend, and so Wave 3 often extends 161.8% of the Wave 1 and 2 pullback. So what do I mean by that? So okay, let us do away with this pullback. So Elliott Waves, the good thing, and the thing that I like about Elliott Waves is that we use fibs as well. We incorporate the fibs within the price action as well. So what's the target for wave 3? Well, it's usually based on the first impulsive move down of wave 1. Then we take that as the low point and we draw up to wherever wave 2 is as being the starting point. So that's your starting point. And then we'll look for the fib extensions, which are the 161 ideally, the 161 fib extension to the 176. So 161 ideally is pretty much what we look for. So always down to around this level as our target, and that's wave 3. And as you can see, based on this price action, we had that. And so from point 2, which was up at around 136.71, to the completion of wave 3, which was down to 134.50, that's 220 pips. So a wave 3 move was 220 pip move, wave 3, Elliott Wave 3, which was perfect. So then we go on to wave 4. So wave 4 is often, you'll see some sort of a pullback, corrective pullback for wave 4. And this is typically around 38.2% of wave 3. So let's get rid of these fibs. So this is why I was talking about why we're always constantly adjusting our fibs and having to replot them and redo them, because you can't just put them on a chart and then leave them and think that they will serve every single movement and price action. It doesn't work that way. So with Elliott Wave, it forces you almost to keep doing your fibs, readjusting them. So here we are saying that wave 4 is a 38.2 pullback. So usually it will be like a small correction. And sure enough, we were in a wave 4 correction, and it was going really, really well yesterday, and it was perfect. We were consolidating, and we had a little bit of a breakout because they were talking about Bank of England Governor Bailey was going to be speaking. And so what happened there was the news fundamentals trumped everything, and the news basically said, yeah, forget your Elliott Wave technical analysis and all the rest of it. We're not going to continue a wave 5, which is quite a smaller wave, probably about half the size of a wave, about on average half the size or less to a wave 3. It may only even be just a simple case of a simple retest of wave 3 to the downside. What I mean by that is, if I show you this very quickly, so we were in this corrective wave of wave 4, and had the Bank of England governor not come out and said that we're not looking to entertain negative interest rates, so fundamentally the pound was given assurance that it could maintain its strength, and so that's why it rallied today. Had that not been the case, had there not been any news, then technically we would have still been bearish, and we would have been looking for an N shape to basically come down and retest wave 3. And so wave 4 to wave 5 could typically be like a retest of wave 3, and then slightly extends, maybe 127 extension approximately would give you something like this, wherever the high is on this pullback, basically something like that as a 127 extension. So you're probably looking at around 134 roughly, give or take. So the wave 5 is never an exact science. All we know that wave 5 generally lacks the huge enthusiasm and strength found in wave 3. So wave 5 advance is caused by a smaller group of traders, and these smaller group of traders are often retail traders that have come in a little bit too little, too late. They see that we're moving in a direction that we've all been trading for maybe a day or hours or God knows how long before, and then these traders come in and they want a piece of the pie. But they are, unfortunately, this is when many average investors finally decide to get involved right before the end of the move. So the volume is often lower in wave 5 than wave 3. So that would have been the case. The reason I wanted to highlight this is because it's important to understand that although we do have these impulsive and corrective moves and these Elliott wave movements happening all the time, and they're really easy to start spotting and seeing. It's important to understand that the fundamentals do dictate the market, and so if we have some solid fundamental news like we had today, then there are always going to be exceptions to the rules, and that's why trading is a game of probability, and that's why we can never say for 100, with certainty 100% that is going to play out, that the market is going to do exactly what we would want it to do, because that's the markets for you. And I think as a trader you will know that and appreciate that. However, you're playing a game of probability, and more often than not you will see this sort of price action play out really, really well. And let's use this as a real life example. So wave 4 to wave 5, I wouldn't be interested in this anyway. I was already looking to take my money around 135, so I was pretty much done, so I had no interest in going short here anyway, because it was already way too low. Now if we'd broken down here, we would then be looking for an ABC correction, which doesn't necessarily have to happen, but generally is something that we would often see, which is basically consolidation after a move. So we have these wave 1, 2, 3, 4, 5 wave price action movements, and then what we'd be looking for is something like this, like an A, B, C. So it would be an A and then a little bit of a pullback and then a C correction, which would maybe go back up and test pretty much where we had broken out from. And that would be the end of that move, and then everything would reset and start again. So that's what we would look for. But of course this didn't happen, and the reason this didn't happen, and just to point you in the right direction and stress the importance of the fundamental news, that was what dictated the markets, dictated this move, the pound dollar move being bullish, and that's why we went long on it today, and I've made some decent profit. Hope this helps as one Elliott Wave example, and I will do another one on the euro dollar, because the euro dollar also has a good setup, but we'll do that in our next video.